Hi, it's Tuesday again, and it's Tip Tuesday from Jeff Vogan here at Premier Retirement Planning and Wealth Management. I know the last 2 weeks we talked about don't freak out, and you know what? It's still true. I'm going to still hold to that theory. Don't freak out if you're not retired and you have 10 years to wait this thing out. Continued volatility is getting people freaking out and doing a lot of maybe crazy things. However, just like I said, I'm going to double down on the other part that I said too, is if you are freaking out, it means you have too much at risk and you need to get out and pare that down. So if you haven't done that yet, I'm sorry, you're locking in losses if you need to use that money in the next few years. Or, well, it just means you might have to continue to work a little longer before you can afford to retire. Remember, if the stock market goes down 50%, like it did the last two market corrections, the big one in 2000, 2001, and 2, and also in the 2008 correction, those markets took 5 years. That was on the S&P and the Dow to get back to even. So if you were planning on retiring, you had enough to retire a month ago, continue, to get back to that same spot, you may have to wait it out. Now, I don't know how bad this coronavirus or how bad this oil war or how bad trade wars or whatever's going on in the world that's giving the market an excuse to correct like it's needed to do for a long time. I don't know how long that's going to take. I don't know how long it's going to go down, but I do know that everybody knows, who has a rational mind and knows history, that the market has been overvalued for a long, long time. Warren Buffett still has said he's not ready to buy stocks. He expects his own investors to wait out at least a 50% correction. We're not there yet, but we're heading there fast, especially when you have 1,000-point ups and 1,000-point downs and even more on a day-to-day basis. Crazy things like we've never seen before. Now, again, if you can wait it out, keep putting that money, that dollar cost averaging money, the same amount of money you were putting out of every paycheck, continue to put that away. Now, keep in mind, there may be some market volatility, some negative effects from this market volatility, and that may be economic effects. If you don't have a very secure job, make sure that if you don't already have 6 to 12 months of staying power in the bank, so you can wait out a recession or a depression and get a new job, a suitable job that will pay the bills, make sure you get that out of the market. You may have to take a loss, but that may still be the smart thing to do, because you need to have that money set aside in a safe place that you can live on it should things get even worse. Now, I hope things don't get worse. I mean, don't get me wrong. It's been a long time in coming that there's needed to be a correction. In fact, if you look at the overall value of the stock market, where it was compared to kind of an equilibrium value of where the stocks ought to be to get to average, where you should buy stocks to get, say, an average rate of return over the next 10 or 20 years of, let's say, 10%, which is what the long-term average is over the last 100 years or so. The market still has to go down another 400 or 500 points on the S&P, another 4,000 or 5,000 on the Dow. So we're still not at equilibrium where, historically we're even at fair value. We're still overvalued. So there could still be some downside if the market is correcting to find that equilibrium point. Unfortunately, when that happens, it doesn't stop at equilibrium. It usually goes past that point to where we get even more incredible opportunities to buy low. When the market is down, let's say the Dow could go down to 12 or even or 12,000 or 10,000 points. It's not many gurus say it could happen. If it did, that would be an incredible time to buy. Keep liquid, keep some money aside so that you can buy in when that bottom happens. Again, I'm talking to people that haven't retired yet, that have money that want to go back in. And if you are retired, take that money off the table now and buy back in low if you can. That's where tactical money management comes in. More than a week ago, we got all of our tactical money managers got out of the market. We didn't like what we saw coming. We got out. We're in protection mode now. We're going to wait for those opportunities to buy back in. And we're looking for opportunities to protect those assets for those people who are retired or planning to retire soon. You can't afford to take a loss by selling low just in order to make ends meet or just to pay living expenses. So please, if you haven't already done so, call an advisor. If you don't have one, call us if you want a second opinion on what it means to you to protect your assets and protect your future retirement or protect a retirement that you're already starting. I don't want you to freak out, but I also want you to make a plan. If you are freaking out, it's probably because you don't have a plan or you're not sticking to your plan or the plan wasn't a good one in the first place. So reevaluate your plan, quit freaking out, and let's just get on some solid footing and move forward and get through this thing okay.